Hi, I'm Mike Gassewitz, CEO of TriCert Financial Group. Welcome to another episode of InFocus. Today, we're going to talk about our energy and materials sector, and joining us today is Grayson Waechter, our portfolio manager responsible for this sector. Welcome, Grayson.
Hi, Mike. Thanks for having me.
So, Grayson, good to have you on the show. Talk to me about the sector and how have they been doing from a business perspective?
Yeah, absolutely. So the oil sector, first one I wanted to kind of touch base too. And for the most part, it's been going very, very well. Essentially, if you look at the price of oil, it is down from their highs about 18% from the high of 52-week high. But when we look at earnings that are going on, everything's really going quite well with them. So if we try to sum up where the returns in that sector are coming from, it gets really easy to do. It's return to shareholders. So companies do that two ways, through a dividend and then also through buying back their shares in the market. So when we look at the big international guys that we invest in, our Exxon, Chevrons, and Shells, they're actually at record levels of those things. So our clients are enjoying nice dividends above 4%. They're also enjoying share buybacks between 4 and 6% that look fairly sustainable for the next 5 years for those companies. So right now, oil's trading around the $70 mark, usually low 70s. And it's really great business for them.
All right. Well, that's good. What about on the materials side? Anything there?
So on the materials side, we've seen a little bit more turbulence in that with regards to the core picks. One of our companies, BHP, it has a nice diversified portfolio that they provide clients percent of their profits of dividends. So as those commodities get a little bit more volatile and towards the low end, that does seem to come down a little bit. But we do have some other core picks that we have kind of rounded out the names with as well that just pay a per fixed dividend going forward that we're expecting them to increase as well. So when we look at names like Martin Marietta and Air Products, they're not beholden to that commodity cycle quite as much. So we're using them to round out and take a little bit of the edge off that cycle that we do have.
And remind me again, why is Martin Marietta in the materials side of things?
Yeah, so Martin Marietta is basically a aggregates company, and that's a big fancy word for rocks. So They basically sell crushed rock. And the nice thing about that is they have pricing power. So when you look at the crushed rock business, usually when you travel about 25 miles to a job site, you've hit this crossover point in which it costs you more on gas than the actual materials you're using. So essentially what they're able to do is buy up a bunch of these aggregate sites all across America and essentially increase production, increase the price. Right now, if we look at what we're looking at, we're looking at volatility in commodity prices. We're looking about talks of tariffs. It's a nice example of a company that's 95% insulated from that. They're a little bit tied to government spending with regards to these larger infrastructure projects and a little bit towards the economy with regards to housing starts. But for the most part, year after year after year, they just increase the production by a little bit, raise the price by a little bit. And it's nice to see something in this world when there's all this uncertainty that's a little bit more certain. The only thing that's unfortunately uncertain about their business is the weather, because that does affect construction season. But at the end of the day, especially, what we're going through right now, I'll take that as an assumed risk any day.
Yeah, for sure. You did mention tariffs. We'll come back to that a little bit, but maybe, that's a good summary in terms of how the businesses are doing. In terms of the markets and how they've reacted, any commentary there?
So we haven't had too much reaction overall on any one particular industry. The only one we saw a fair not jump, but almost dive down, was on Camco. So they're our play on uranium. They've been very, very expensive for us for a numerous amounts of reasons. And when we look at justifying the price in the market today, a lot of things that are baked in is perfection. So we talk about tariffs, but the thing that actually had them drop about 15% in one day was the actual AI coming into China. So it was the idea that there's something out there that's more efficient. We might not need all these data centers. Those data centers might not need power, and it caused the stock to drop 15%. It's recovered, not to the full extent because of that, but it was just kind of interesting to see that, the news out of China is something that does affect our core picks as well. A lot of it is to tariffs, but there are also other changes abroad too that have just much impact on our core picks, but aren't necessarily directly related to tariffs, and they're not quite getting as much attention, but they definitely would be meaningful.
Okay. So you said the T word, not taxes. I'm talking tariffs here, sadly, on everyone's mind. Yeah. Give us your thoughts in terms of, let's say, some of the companies that, we have in our core pick list and, from a positioning perspective on the tariff side of things. Any thoughts there?
Yeah, so primarily on the oil side, we have been phased away from Canada. It's something that we're looking at, but now that the tariff situation has started to rear its head a little bit more, we're a little bit more hesitant to do, even though we do like some of the margins that we're seeing. If we go back to what we're seeing on the international side, plus 4% dividend, 4 to 6% share buybacks. So for us, that's a great situation to be in. We'll always look our heads to see if there is something on the Canadian side, because we do like that Canadian eligible dividend being taxed at a lower rate. But we also kind of, when we look at the lay of the land and we look at the U.S., it's a little bit tricky to see the path ahead, because it's a little bit tricky to see kind of what they're complaining about. And if you look at, all in all, America gets about 4 million barrels a day out of the U.S. And out of that is about 75% heavy oil. And the interesting thing about the heavy oil is America and Texas has a lot of these refineries, and they're not actually able to process the oil for the most part that they make in America. So they had a lot of excess capacity that they looked at and said, okay, how can we make money without a big retrofit? And we go, okay, well, we can take barrels from Canada, put them into refineries, process them, and then export them abroad and make some money. And that's important because the U.S. is a net exporter of oil. So when we look at the actual situation about deficit in trading, it ignores all the value creation that's being done, especially to the American economy. So that's something that we're very aware of when we are looking at what happens with the Canadian oil sector, especially if we see more turbulence. If something becomes cheap that we like, we would scoop in to pick that up. Now, from international picks that we do have, they all do a good amount of business in the United States. The Permian Basin is something they've all been investing in quite a lot. So we're very cautious and looking to see what would affect that from their ability to export oil, because they are net exporters. So if tariffs start getting slapped both ways, it is going to affect them as well. Even though we're dealing with a 10% tariff, not the 25 and everything else, that is something that we see something that doesn't necessarily make sense to us, and it'll be interesting to see how it plays out.
You are very politically correct that it doesn't make sense to us. Yeah. Well, I've said it on a few podcasts. Sanity hopefully will prevail. But okay. So that's a good view from a oil perspective, energy perspective. Talk to me about any other of our picks in terms of how they're positioned on the tariff front, if the threat does come to fruition.
Absolutely. So there's two commodities that no exceptions have been eked out for at all, that would, for the most part, pretty much hurt America, by anything reciprocal going on them. The first one is potash. So we provide 90% of the United States potash.
Wow.
Yes.
Okay.
And so far, there's been no exception to that. So when we look at that, we definitely see. So we have exposure to potash through Nutrien. And when we look at that tariff coming into place, farmers can go a season, maybe a two, reduced orders to kind of get them through that. And I think that's kind of what they're planning to do. So we have to look at potash itself and what's going to happen to that market. So if it starts to weaken, that's one thing. The other thing that we have coming up in 2026 is there's a very large potash mine coming on. It's called Jansen Potash Mine out in Alberta and Saskatchewan. And that is owned by BHP. So they're going to bring on about 5% of the world supply in phase 1, and a couple of years later, another 5% in phase 2. And that's something we've been watching because we do have exposure in nutrient, and we want to make sure that we don't start flooding the market. The other thing that can be very meaningful to the potash situation is what's going on in Ukraine. So if there ever is a peace deal that does come up, it really interesting to look at how the U.S. would view Russia from that point. Conceivably, sanctions would still stay on, but if it was something that they did move off, it would start having some of the exposure of potash from Belarus and from Russia possibly coming back into this way, or at very least, they can start demanding a higher price because the sanctions would come off. So that's one thing that we do have exposure to, with regards to tariffs, that we're definitely keeping an eye on the situation.
Okay.
And the second one, and a lot of clients have talked to us about this for quite some time, but copper. So there's no exclusion being eked out in copper. America does produce a large copper amount, but I'd say they import about 40% of the needs. So if we start looking at, building things in America, but now we have to import copper from abroad, which have tariffs on it as well. And we have a lot of exposure for copper for tech. So Tech Resources is one of the picks that we have. They had gotten rid of their coal business about a year ago, and they're primarily copper and zinc right now. And their mines are most part abroad too. So I'm not going to try to be the tax accountant that figures out who gets tariffed on what coming into the United States. But if they are putting a blanket 25% on that, it's definitely going to hurt any type of manufacturing goals they have in the States if the most important commodity for the next 20 years gets more expensive for them.
Yeah. I mean, every time you go look under the hood on this whole tariff discussion, it is a bit mind boggling. And again, you have the hope that saner minds will prevail. So, all right. Well, Grayson, thank you so much for this.
Thanks for having me.
Folks, as always, if you have any questions on anything you've heard or about your portfolio, don't hesitate to reach out to your accounting firm advisor, financial advisor, your TriCert Investment Counsel portfolio manager, or don't hesitate to reach out to myself. Take care.